Finovate showcases cutting-edge banking and financial technology through a global conference series featuring short-form demos and thought leadership. Now, the conversation continues on the Finovate podcast.
Hi, and welcome to the Finovate podcast. Joining me today, we have Neil Kenley, principal at Vistara Growth. Neil, thanks so much for joining me today.
Glad to be here. Excited to chat.
So to kick things off, can you give us just a quick overview on yourself and Vistara so our listeners have some background?
Absolutely. So I joined Vistara about 3 years ago to head up our Toronto office, and I lead our Fintech practice. At Vistara, we are providers of flexible and creative growth capital. But ultimately, what that really means is we provide debt, converts, equity, kind of everything across the capital structure to businesses and startups looking to kind of continue to, as we like to say, own their growth.
Yeah, certainly a lot of talk about the fintech ecosystem from a venture capital standpoint. And I'd like to start with a question that I've been asking a lot of the VCs who've been on the show lately, which is simply, what is your perspective on the current funding environment in fintech? Do you think that we're at a new stasis point now, or do you expect to see valuations and funding levels shift significantly over the next couple of years?
Yeah, it's certainly been an interesting ride over the past, call it three or so years, as things have shifted pretty materially, both up and down. Where we are today, ultimately, I think the goalposts have moved for founders and VCs, frankly, where the expectation is continue to grow, but do so more and more profitably, deeper looks at unit economics, et cetera. And what that has effectively done is created an environment where the top companies and those that have been able to make adjustments to reach that, or at least a path to profitability, see funding in large numbers, and those that are still working to make their way there need to find stopgaps and buffers to continue to meet those plans.
Yeah, I think this is one of those areas that obviously, there should be more focus on profitability, but there's also this balancing act because in many cases, some of the most successful fintech companies, aren't profitable for quite a while before they end up becoming really profitable. How do you kind of look at that balance and sort of say, is it about demonstrating real-time profits now, or is it just more about having a clear path to profitability, which is kind of the bigger factor, do you think, at the moment?
I think that path to profitability is incredibly important, but also a reduction in burn from historical levels for those that were burning significantly. I think that I think we're certainly in a show me market and not a tell me market is probably a good way to put it. Where if you can really demonstrate that growth is there, that you have the ability to run lean and run efficiently, that can work out really well. But really need to have those proof points under the belt.
Yeah, I think the burn rate is a really important one as well, because for a little while there, we were operating in a system where there was not really too much of an incentive for people to rein in the budget at all, right? There are some outlandish things happening in the fintech space. You think, well, you probably could get away without spending quite that much money. But now I think, looking at it just from being slightly more disciplined, right, slightly more serious and intentional about where the funding is going and getting that return is obviously something that's going to be really important. And I sincerely hope that whatever happens to the funding ecosystem, we keep that more disciplined nature, because it is really good for the industry, and it's the quality of products and innovations that come out of the startup community will undoubtedly be better based on some of these pieces. I also want to talk a little bit about a different topic here, because fintech founders don't need to be completely reliant on one type of capital source. Can you talk about some of the other forms of capital that founders should be aware of?
Yeah, of course. I think the number one thing that is most founders think about when raising money is equity, and that's certainly one form of capital and makes a lot of sense in some scenarios. But as founders look to other potential solutions, especially in interesting markets like this, there is bank debt, there's growth debt, which is where we focus on at Vistara, more traditional venture debt. There are revolvers, convertible notes, royalty structures, kind of you name it. There are interesting ways to fund businesses kind of across the board.
So what are some of the advantages of going with some of those other routes instead of the more traditional equity path?
Yeah. So with equity, of course, a big part of what you're doing is selling a portion of your business to a VC, which has a ton of benefits, but or can have a ton of benefits, I should say. As you look at some of these other funding options, uh, typically what you're going to see is something that is a lot less dilutive than the equity side, and from while there's different costs associated with each one, ultimately from a debt perspective, especially on a growth debt perspective, you can typically fund your business in a way where you're maintaining a significant portion of your business upon exit. We have a number of our companies in our portfolio. Founders own 50, 60, 70% of their businesses upon exit, to fantastic outcomes, 8, 9 figure exits.
Can you talk a little more about the structure of that kind of growth debt? How those deals are typically put together, and what they look like at the start?
At Vistara, we are investing anywhere from $10 to $40 million through these structures. And typically what they look like is a 3 to 5 year non-amortizing term loan. So you're not paying back principal over the period of time, with a bullet payment at the end. So kind of at that maturity level, at that maturity point, you're able to go, you'd able to look to refinance that with other debt, equity, or some other form of capital to refinance that facility. Along the way, there is, of course, an interest payment associated with it, which can be a mix of cash as well as an accrued payment, which doesn't come out to reduce overall outflows of the business. And then, as we see it, you would use that capital to invest how you please. So, continuing to invest in sales and marketing, product, et cetera, to continue to grow the enterprise value of your business.
How does that change the dynamic? Because I know a lot of the times when you engage with a venture capitalist, you do kind of give them the ability to come in and weigh in on some of those big, important decisions around the company itself. Is that different with the kind of growth debt model? Is there more control maintained by the part of the founders?
Yeah, ultimately, when we look to partner with founders, that is, we trust those individuals and look for them to be good stewards of capital. We typically look for a board observer seat, where we can help and advise and try to be true growth partners. We see us as growth capital. We happen to structure as debt, which has something different than equity from a structuring perspective, but ultimately as a use of proceeds, as a way that we want to work with our companies. We try to see ourselves very closely. We happen to structure this way. We're not a bunch of bankers who we're not bankers who happen to focus on startups. We think about ourselves as growth investors who happen to use debt.
How common is this? Are you pretty unique at Vistara, or is it something that you're seeing more of in the space?
We're starting to see more and more of it, especially as folks are trying to wrangle valuations from 2021 and 2020, early 2022, where capital's been raised and ultimately folks are looking to continue to grow and invest in their businesses, but trying to avoid things like down rounds, or potentially challenges with raising additional capital. Debt could be an interesting solution to that, where we're not pricing equity in the moment, but you can continue to invest in your business and grow.
Yeah, no, it's a really interesting concept. So when you talk to fintech founders, what advice do you give them about where they should be thinking here? How do they go about deciding what kind of capital source is right for them?
Yeah, ultimately, in our view, the use of proceeds, the maturity or stage of the company plays a big role as to whether you should be taking debt, equity, or something in between. For us, we typically invest in companies that are 10 million plus in ARR, which creates a level of scale and stability. And typically there is a go-to-market motion that exists. Maybe there's some additional investment being made into product or sales to continue to grow the enterprise value of the business in a fairly secure and stable way. Of course, there'll be bumps along the road, and we're partners in that process. But for earlier stage companies, though, that are taking more kind of bet the company moments or investments, equity likely makes a little bit more sense there. Overall. And then there's also things in between us or even less quote unquote riskier capital like bank debt, which is typically goes alongside an equity round for us. And the way we think about growth debt is equity is not required to come in alongside. And ultimately it really is a risk return profile on the business and what you're trying to accomplish.
Yeah, and certainly I think it's good for founders to be aware of the options that they have. And I think also it's good for them to be aware of what the trade-offs are. I think a lot of founders early on perceive equity in the company as something which they have a ton of, right? And they do. You have a lot of equity in the company. You can trade that equity to get capital that you need right now. But that equity is not inexhaustible. And I think treating it like it's a precious commodity, or at least looking at how much you're actually getting for that and what other sources you could potentially accomplish that same capital raise with slightly maybe not cheaper cost, but a different type of cost is really interesting. And it's something which I think a lot of companies should be spending a lot more time thinking about. We've always had this role at Finovate where we talk to a lot of early stage companies. And one of the things I always like to tell them is, don't take capital for no reason. Make sure that you have something that a concrete need that you need to spend that money on. It's not about getting your valuation as high as it can be in the first couple of years. It's about building the team and the tools that you need to become successful, and you start thinking about your company valuation much further down the road. And hearing you talk about some of these other options, I think is really intriguing. And I certainly hope that a lot of the companies that are listening to this go out there and do a little bit of digging on what options are available to them. I'd like to end by coming back up to the really high level and looking broadly at the types of opportunities that you're seeing in the fintech space, both in terms of what your portfolio is actively targeting, but also just more broadly, where are the opportunities right now for fintech innovators to really come in and make a big difference?
Yeah, what we're seeing in an area that we've had a lot of success in the past, where we continue to focus is startups and businesses selling into financial institutions to effectively modernize them. A lot of these, whether they're regional banks or even some of the large institutional tier one banks, use legacy systems where they're basically maintaining them themselves, or they're a collection of other tools that can effectively be amalgamated and brought onto the cloud and can successfully be improved. We're seeing that tremendously across, whether it's the platform folks use to manage their credit card systems, or product and pricing as they think about core modernization. We have companies in our portfolio that focus specifically on those areas and have been tremendously successful. So ultimately, the improvement and enhancement of legacy core systems we see as an area where there's going to be tremendous success and frankly continued growth into the future.
Yeah, certainly there's no shortage of opportunity down that side of it as well. Do you look at any of the kind of B2C plays, or is that something which you think is a little bit more difficult in the fintech space right now?
Yeah, it's not an area we focused on. We certainly have looked at opportunities in that area in the past. For us, a number of times, getting down deep into the unit economics of those businesses, those often look like good equity bets, where there is significant upside. On the debt side, that's a little bit more challenging for us, as oftentimes there are significant sales and marketing dollars being put to capture customers, and ensuring that those folks stay with you for a long time can be a little challenging. Not saying we haven't looked or won't continue to look at them, but still looking for the right opportunity.
Yeah, no, absolutely. And I think it's one of those things too, where there's just so much opportunity right now on the side of the financial institutions who quite frankly desperately need the help in many cases, that there's always going to be room for a good B2C play. But I tend to agree with you that it looks more like the opportunities on the B2B side, or even the B2B2C side, are going to be a little bit bigger in the short term, potentially for the next couple of years as well. Well, I'm afraid we're out of time there. We're going to leave the conversation here. But Neil, thank you so much for joining me.
Thanks a ton for having me. It's a great chat.
The Finovate podcast is produced by Informa Connect in association with Provoke.fm Media. Check out Finovate.com for information on Finovate's upcoming shows and to learn how you can get involved. The discount code Finovate Podcast will save you 20% on tickets to all of our events. And you can email us at info@finovate.com for information on sponsoring, speaking, or demoing. Thanks for listening.